So we mentioned in one of the other videos, there are really 4 criteria into getting a mortgage. We talked about credit score and your credit history. Well, what are the other 2? Both of the other 2 pertain to money. The first is your down payment. Everyone knows that you need to have a down payment to buy a home. At one point, there were loans out there that had 0 down. You could literally walk in and get a loan without putting any of your own money down. And at this point, those are basically non-existent. There will be a couple of loans out there if you live in a rural area where you can get a federal rural development loan, which really is a 0 down loan. VA loans are largely 0 down. But in general, most of your loans will require between 5 to up to 20% down. So it's very easy. Just figure out what the price of the home is, multiply that by 5 to 20%, and you've got an idea for the amount that you need to save. Most people that we've worked with over the years don't have huge amounts of money just sitting in the bank. And so that's part of our program, is just sitting down, looking at your budget and saying, okay, how much money, if we were working really hard on a very specific plan, how much could we save in a month's time? And there's all kinds of things that we look at in there, and we've got spreadsheets and all kinds of budgets that we've created over the years that are very, very helpful in identifying where you can save money. That's a centerpiece of our plan, is helping you carve out anywhere from a few hundred to possibly a few $1,000s per month out of your budget. If you're saying, well, I can't do that, there's no way I could carve out that much, that's fine too. We've had people work 3 to 4 years in saving money before they were finally able to do it. But the key is very, very simple. Create a plan and then stick to it. And that's all you've got to do. So that's your down payment. The final of the 4 issues. So we've talked about credit score, credit history, down payment. So the last one is your debt to income ratio. Obviously, if you're going to loan money to someone, your number one interest is, are you going to be able to pay me back? And that's how the banks are too. And so what they look at is they look at your gross monthly income, and then they lock that basically in half. They say that half is going to be used for food and all kinds of just expenses that you're going to normally have. So we're going to take that right out of the equation. Then we're going to look at what other debts you already have. Obviously, if you have other payments, student loans, car payments, credit card payments, that money's already spoken for. So they cut your money in half, they subtract out your other monthly debts. The amount that's left over there is the amount that they'll be willing to qualify you for your monthly payment. And that's another thing that we can work with you on to identify what price of home should I be looking at so that we don't get you overextended right out of the gate.